We've got Killol Pandya. He's a senior fund manager debt at LIC Nomura Mutual Fund joining in on the show. Killol, thanks for being with us. To start off with, there seems to be some buzz on the street that the RBI may shut the forex swap window for OMCs. How do you see this information playing out for the currency space?
The currency has stabilized, it has appreciated pretty much all the primary objectives of RBI at the time when it had taken the measures to make sure that the currency stabilizes are playing out at least up to now. So in a way it does make sense for RBI to go ahead with unwinding some of these measures which it had taken in the interests of protecting the currency. Of course, if RBI does engage in this measure, then some amount of volatility once again may come into play as far as the currency is concerned. And the same can be said about the measures which RBI had taken regarding liquidity as well, with an eye to stabilize the currency. So as and when RBI does unwind the steps it had taken to stabilize the currency, there will be some knee-jerk reaction. However, as long as the currency, as the broader currency remains stable, I don't see any far-reaching impact of these steps being unwound given our current situation. Of course, the backdrop continues to be of medium-term volatility, but as far as the short-term reaction is concerned, it should be muted.
So, then my question is, even if the RBI measures, some of the unwinding were to happen over the course of the next couple of months, maybe getting the OMC buying back into the normal window, would that mean that the days of 64-65 are out, even if such measures were to happen?
It's difficult to predict actually. We were caught unawares when the rupee slid all the way down. We are happy that it has moved to this range and is maintaining there. But see, the steps which RBI is taking are in conjunction with how it is seeing the international situation panning out as well. There is a breather which has been provided to us by the US government to the broader global economy. If that is party, or that is one of the reasons why there is stability in the various currencies against which the dollar is ranged against, then so be it. In that context, if RBI believes that at least till January, February, if the currency situation will remain stable, then in part it may choose to engage in this rollback without the currency sliding down all the way to 65 levels again. But like I mentioned, the backdrop to this continues to be volatility and fluidity in the domestic as well as international markets. So maybe a gradualist approach is in order. Maybe all the steps may not be rolled back all of a sudden. That should go down well with the markets. Some amount of gradualism may ensure what you have just mentioned. It may prevent the rupee sliding all the way back to 64-65 levels.
Moving away from the rupee, Killol, you've got the inflation metrics. They continue to remain on the adverse side. You had the CPI as well as the WPI inflation numbers coming in fairly high. And once again, food inflation continued to remain a worrying factor. Do you think that we have to brace ourselves for a number which is likely to be in double digits for many months to come now?
From the context of inflation, I think double digits is still quite far away. However, what you have pointed out is quite correct. We continue to see CPI as well as WPI playing against us. Food inflation continues to be sticky despite good monsoons. This is something to be worried about, and RBI has mentioned it explicitly that inflation is something which is worrisome. No doubt it will play some part in the contours of RBI's policy and steps as we go ahead. So yes, inflation continues to be the number one worry from a short-term perspective as far as RBI is concerned, and also by proxy the bond markets.
So is it a given that a repo rate hike is then in the offing on the next RBI policy announcement?
See, there are three possibilities as to how the rate actions may pan out in the coming policy from the context of RBI's own intention of bringing the MSF and repo corridor to 150 basis points, to 100 basis points, sorry. Currently it is 150 basis points. That can mean an MSF cut of 50 basis points, a repo hike of 50 basis points, and an MSF reduction of 25 basis points, and a repo hike of 25 basis points. As things stand now, the option which will serve the maximum number of RBI objectives is the third option, which is a repo rate hike of 25 basis points and an MFS reduction of 25 basis points. So that possibly is how it may pan out. As things stand now, like I mentioned, it seems to serve the maximum number of objectives which RBI has set for itself. The impact which it will have on the bond markets is that it will encourage the bond markets to engage in some sort of steepening. The longer end may move up with the shorter end dipping down. The pivot, however, will be closer to home rather than longer out. So possibly maybe a 3-year segment might be the pivot around which we may see some curve steepening.
How do you see the macro data shaping up over the next couple of months? I mean, the CAD numbers or the trade data numbers, the last release was fairly positive and people would hope for more such releases.
Yes, hope, the world floats on hope. However, given the fact that we are going into an election year and given the fact that the race is hotting up as, we all thought it would, in that context, I personally remain worried about how the fiscal is going to pan out. If we do see some more populist measures creeping in, then it does not bode well for how the fiscal is going to pan out. As far as the CAD is concerned, given the fact that the global economy continues to show patchy performances and that the domestic economy is going to have a U-shaped recovery rather than a V-shaped one, I really don't see the CAD improving exponentially as we go ahead. No doubt the hope is there that as the CAD improves, things will get better. Even if the CAD stabilizes, doesn't deteriorate or kind of remains at par, then there will be some reason to cheer. However, I do remain worried about the fiscal front.
And do you think that the bond yields are likely to trend higher in the near term?
Like I mentioned, if RBI does engage in further repo rate hikes, which is probably what in some form or fashion is being factored or is being considered by the market quite seriously, in that sense there will be some steepening which will take place. So as far as say the benchmark 10-year is concerned, we have already seen it move up to 8.6, which is where it hovers as of now. If RBI does engage in a 25 BP repo hike in the coming policy or somewhere around that time, then we may see the 10-year trend to slightly higher, maybe towards 870. But I don't think it will run away with itself. 9%, something like that, is still quite far away. But as I mentioned, as and when we will see repo rate hikes, we will see a steepening of the curve, and the 10-year will move along with it. So to answer your question, yes, some amount of higher trending is quite possible as things stand now.
Great. Good having you, Killol. Thanks so much, as always, for taking the time out and being with us.